And again, the importance of investing in being able to architect and create these new sustainable and scalable models for delivering affordable and accessible healthcare to people. It has several different components. And so now to talk about those will be Bill again, talking with Paxton from North Pond Ventures and Ian from Fenwick to have a little bit more detail, build a little bit more color around what's happening to build these equitable and scalable models. Bill.
Yep. Thanks, Dan. Great to see everyone. Thanks for coming out today. My name is Ian Goldstein. I'm a partner at Fenwick & West. I spend my time sort of working with venture and strategic investors, including Bill and his team at Merck, and then spend a lot of time working with digital health, life sciences, and other technology startups all around the ecosystem. So as Stan said, we're going to talk about funding, right? The funding environment has certainly changed, we'll say, over the course of the last year. And we're going to get perspective from, Bill from a strategic investor perspective, and then from Paxton from the financial VC perspective to really sort of analyze like what are they seeing in terms of market trends on the funding environment today, and what do they see on the horizon? How have terms changed, and how does that affect exit opportunities and how to think about growing your business? So I'll just start off and ask sort of maybe Paxton, why don't you start? Because Bill, you already introduced yourself, and then we'll get right into it.
Thank you. So Paxton Major, Vice President here at North Pond Ventures. Just the maybe brief commercial on North Pond. So $2 billion under management, investing out of a $750 million vehicle. About a third of our portfolio is what we call digital health, digital life science. So we invest software, computation, data platforms, all the way from drug discovery, preclinical development, lab software, biomanufacturing, bioprocessing, clinical development. And then maybe what's most interesting today is care transformation and precision medicine. So we do the whole spectrum of life science in healthcare. Series A through Series C is really our sweet spot. Some type of product market fit, doesn't necessarily need to be revenue generating, but at least there's some inclination that there's a market for the technology. Typical investment size, $10 to $20 million. We can't go smaller, we can go earlier, we can go later. So we really do see the whole spectrum of digital health. I would say we have about 20 or so companies now in the space, 65 overall. So we also have a drug development biotech arm, as well as a tools and diagnostics arm.
Great, thanks, Paxton. Bill, anything you want to sort of add to what you already mentioned on your prior discussion?
I think everybody
All right,
kind of got my info.
good. Well, let's jump right in. So, Bill, so how have things changed over the last 12 months from a sort of funding environment, like ecosystem perspective?
Yeah, so I think for us, one of the big things, and certainly for a lot of our co-investors, probably the biggest thing that happened in 2022 was the amount of debt that was raised by the companies, partly because they previously raised at rounds or valuations that were rather high, and certainly trying to raise above that just wasn't going to happen, and probably weren't quite ready to do any kind of cram down or recap. And so we did a lot of debt. And of course, with that, then, happens, we're just kicking the can down the road. But I think that was the biggest trend that I saw, and a more stabilization, I think, of new investments we did, lower valuations. They started to come down, not dramatically, but certainly came down quite a bit. But I think that was the kind of probably two things I saw in this year that just changed the way we were investing. Was just, I think we did 9 follow-on investments, all were debt, of some of the follow-ons we did. And that's quite a bit of debt, not anything we typically want to do, but we're here to support the companies and keep them going. But I think we just kicked the can down the road.
And is that mostly, insider convertible note rounds?
It's all insider convertible note rounds. Couple of them we did when we brought in, some new investors that wanted to just continue with debt, but 95% were all insider convertible note rounds.
Yep. Paxton, seeing similar trends?
Yeah, I think we're certainly seeing similar trends. I think getting capital into new investments is very difficult right now. So we've seen a really big slowdown in terms of the number of new investments investors are making. I think the public markets have come down There's a ton of dry powder out there, so it gives you a sense that people have really started to halt their activity. So I think there has been this look internally, a lot of investors, of how can we help our companies bridge through what everyone thinks is going to be a really difficult 2023. So you need to make sure that you have the dry powder to support your companies. They have the capital. I think there's been some cut on FTEs and pulling back burn to, again, extend runway, but ultimately you can't go too far down that road because you might threaten the asset, threaten the business. So it's been a little bit of a threading the needle of how can we reduce burn, how can we be focused, spend on what's most important while also still supporting growth and getting these businesses through 2023 into 2024.
And I'm curious, and question for both of you, do you see a distinction in those trends if you're thinking sort of later stage company versus earlier stage companies, right? Or sort of seed and A companies struggling with the same kinds of trends that, B and later companies are?
Yeah, well, I would say the earlier stage probably struggled more to raise capital. I think the more stable, we call them series C or later growth stage companies, and that's where we tend to invest more. We're probably had a little better ability to maintain a runway of cash, maybe make some, cutbacks if need be, but not at the expense of the business just because of their size. So I think from at least from our portfolio viewpoint, the later stage ones did much better, and I think the earlier stage probably still are struggling to raise.
Mm-hmm.
Yeah, I might have a slightly different perspective. So I think if you look at the numbers, I think funding dollars in digital health is down something like 50% Q3 versus Q2. But the number of investments in earlier stage is down something like 10 to 15%. So, and I think Series C or later represents about 5% of the current total dollars in Q3. So I do think there's still a lot of activity in early stage companies. I think the dollar values of those raises might be slightly smaller, but I think if you're looking at a 3, 4, 5 year exit horizon, investors still have a lot of hope for this asset class and hope for the future that you can, once the markets rebound, get a reasonable exit. And I think the valuations on a lot of these later stage companies have come under fire as the markets have crashed. But to Bill's point, I think when you're in that later stage, you have a little bit more flexibility with your cost structure and your revenue to extend runway. And I think part of the data is misleading because I think a lot of these later stage deals just haven't necessarily been announced. A lot of them have been done behind closed doors, either convertible notes, insider rounds, down rounds, and they're not being announced with the same fanfare we saw in 2021, where you raised the big 100 million round, big up round, and there's a lot of excitement around it. So I do think the data is a little misleading, but I also think it tells a compelling story.
Yeah, and I would agree with that because what we certainly with our own portfolio, part of it was just trying to get through 22, 23 and we're making sure they just had enough cash to survive. There was no reason to advertise that, right?
Mm-hmm.
You just, you all agreed as an insider to put whatever you had to put in. Okay, we at least now project out to, whatever first quarter 24, second quarter 24. You did what you needed to do to keep the company moving, and there's no reason to press release on that, to your point. Yeah.
So looking ahead towards 23, do you anticipate the headwinds easing up at some point in 23, or you think 23 is going to be sort of a tough funding environment for digital health companies to raise?
Yeah, I think the general sentiment is that 2023 is going to be hard, if not harder than 2022. I think interest rates are going to continue to rise. Inflation is now more broad-based. It's not just supply chain issues. It's not just energy. I think there's risk of recession. Growth is slowing. So I still think there are a lot of these headwinds. The IPO markets, I think, are still closed. There's something like 300 companies waiting to go public. So what does that mean for the next crop of businesses when the markets do finally open? So I do expect a lot of more difficult rounds in 2023. And again, we've had companies try to extend and push, but at some point you run into a wall and you can't extend anymore, you can't cut. And so I do think there's going to be a continued pattern here that we've seen now in the late 2022. But I still think there's a lot of dry powder, as I said. historic highs. So I still think there's enough out there. I think the best businesses are still getting all investors to consolidate on them. They're raising at healthy multiples, healthy rounds, clean structure. But I think there's a longer tail of businesses that are going to see a tough sledding in 2023.
Yeah.
And I would agree. I would say though, we also look at it, obviously with the debt raising, with the rising interest rates, raising debt again is probably not an option for most companies. But we also look at it we call it the dented can approach. And what it just really means is that there's a lot of great companies out there that are wonderful companies, maybe raised at a little too high of a valuation. There's actually nothing wrong with the company. And they're great companies to come in, perhaps, if you have enough dry powder to recap, work with, partners like North Pond to consolidate assets into bigger assets. So we actually look at it more as an opportunity, believe it or not. I mean, our portfolio is pretty stable for the most part, but we have a couple in there there's a day of reckoning coming. But again, we look at try to, more positively that, yeah, maybe for some of the newer rounds we're going to do, they're going to be smaller, they're going to be, maybe less valuation, but at least for our own current portfolio and current existing assets that had been funded in 22 and 23, I still think there's a wonderful opportunity to potentially come in and again, if they're willing, recap some of these companies at a slightly lower, but not a tremendously lower valuation, but get cash in them because they're really good companies, just got caught in that high valuation sort of market that is not sustainable for the P&L that they have.
Yeah, so I'm curious, maybe you could sort of share some thoughts and some guidance on how to sort of think about what that looks like, right? I think it's been a long time since we've had an environment where down rounds and recaps and other sort of creative financing structures are going to be not necessarily the norm, but more common. And so what can sort of a digital health company that, let's say, is going to be needing to raise in 23, like what kind of terms are they going to be looking for? And how should they be thinking about that kind of approach to funding?
Yeah, I think at the end of the day, a business needs capital. We always call it food and water, and you need food and water to survive. And sometimes it's hard to get food and water, but I think we've been trying to message that you need to be open to those kinds of, not necessarily down rounds, but a valuation that's more reflective of the current market dynamics, or terms that are more reflective of current market dynamics. So maybe seniority on the lick stack, or maybe you're even starting to see some liquidation preferences. Maybe in some rare case, it's participating preferreds. And on the convertible note side, maybe you're seeing a bigger discount. You're seeing higher dividends. You're seeing maybe even some warrant coverage, maybe a change in control. But I think the goal is to live to see another day, to fight another day. And I think that's the messaging, is that companies and investors need to meet in the middle, because ultimately investors are beholden to LPs, and they have an expectation. And so you need certain terms to make your investment. But we're still very excited about everything that's going on in the space, and we want to support these companies. But there are just sometimes discussions on how can we make these dynamics work for both parties, so we can get back to the good work of building these companies.
Mm-hmm.
Yeah, I think Paxton said it right. It's meet in the middle. You can't be too harsh, because you might destroy the company in itself if you come in with a massive cram down and take everybody's equity. But there's lots of creative ways, whether it's preferences, it's all sorts of things you can do. A flat round is sometimes even acceptable versus even a down round if you can add some extra incentives for the investor group. And what I would say, most investors are willing to work with the company, because Paxton's right. We're all trying to build good, solid companies that have good, solid returns for their investor base. And you just have to be creative. But we're very bullish as well as Paxton is, that we think there's a lot of good opportunity for new companies to be funded, and current companies, if you can work with them in the right way, recap them in a way that's fair to everybody, but get them to keep going and exist in the world.
Yeah. Any tips for CEOs and executive teams on how to really sort of facilitate a good sort of board and investor dynamic in advance of one of those rounds. One of the things that I, am sort of consistently coaching my CEO clients on is exactly that. Be like, this is a time to be much more proactive about making connections and building relationships with your investor base, with your board, and making sure that they're connected to each other so that when the time comes for difficult conversations, like the relationships are strong and current. So curious what you both see. You sit on a lot of boards and you have these conversations all the time. Like what are some tips on how to make that a really effective board dynamic and investor dynamic? And what are things to watch out for?
I think one of the things is have the conversations way early. One of the things that drives me nuts, and it still happens, is you get a board call and says, "Oh, we're out of cash in 5 months," right? And it's like, well, that's not what you were showing us. We don't. That's too short of a time frame, right? You got to plan. My advice to you is let's plan well in advance with your investor group, and how we're going to talk to new investors of what is the true timing to give yourself enough time to raise the capital you need to raise. Because what ends up happening is the shorter that time frame it is, the worse it gets for you. That's the problem, because now you're desperate for money, and people see that. And even your own investor base sees that. But I think the planning, and just as you said, the open conversation, but way sooner than ever expected. And I think that's probably the biggest learning lesson for me as a board member is pushing those conversations. Yeah, I know you have enough cash to last 12 months, but that 12 months is going to be on you before you know it. Mm-hmm. Let's talk now about what our next game plan is.
Yeah, I think we're giving very similar advice that funding cycles are 6 to 9 months, and it's not necessarily a full-fledged raise. Data room, you're going and talking to all the investors, but building those relationships, starting to seed the market, having conversations, and then alignment between investors and board of what are we trying to accomplish? What's an acceptable makeup of the round in the financing, so that when push comes to shove, everyone's pushing in the same direction, and you don't go to one investor and they say one thing, you go to a different board member and they say another thing, because I think that can tank a financing. And on the flip side, from an investor perspective, we're starting to make those early discussions. Okay, maybe deal activity is slower right now. We're not making as many new investments, but there's still amazing opportunities out there. And so we want to get ahead of those funding cycles and start to build those relationships with folks, so that when they do pick their head up finally, that we're in a good position. We built that relationship. So it's not first time you're meeting us 2-week sprint diligence, and then all of a sudden you have someone in your boardroom that you met for 2 weeks.
Yep. Another sort of piece of the puzzle that I either see sort of as a very effective piece of the puzzle, and also like the absence of it is a real problem, and that is sort of the independent director seat, right? When you have an effective independent director, that person or persons can really be tremendously valuable in sort of helping the CEO navigate and helping the investors navigate like a challenging environment. But I think too often you see either that role not being filled or not being filled effectively. And I'm curious sort of what you're seeing on your portfolio company boards. And if there are gaps in that role, like how can a company fill that role sooner rather than later?
Yeah, I think independent directors are critical. I think it's really dangerous to have that seat open. I think we've also seen where sometimes independent director might not be truly unbiased. They might be more aligned to management. They might be more aligned to the investor base, but really having someone that's there on behalf of the company, on behalf of all shareholders, and can be that unbiased mediator between sometimes two groups that have opposing views, I think is critical to navigate difficult times. So it's a big emphasis for us to have that seat filled effectively.
Yeah, I think it's important to have that independent director, but it's sometimes really hard because even the growth companies are really startup companies in a sense. And, when you're coming in, even as a new lead investor, you're negotiating for your board seat, and then they've already had the established setup. And, where do you push for that independent seat, saying, okay, who loses their seat? And so it's a tough dynamic, certainly as the rounds progress further. Be interesting to see them be smart about it in the earlier rounds to have that independent seat already having been established. I'm all for them, but it's kind of funny. They're hard to get in, to be honest with you. And that's to your point about that's a dilemma as well.
Yeah, it is. So I'm curious, so pivoting towards, instead of funding, pivoting towards how the current environment sort of is going to affect exits, right? For your portfolio companies or what you're seeing out there, companies that might have to, Bill, I think as you mentioned, might have to pivot towards a combination or an exit transaction instead of doing a financing round. How have you seen the current funding environment impact the exit environment? And how should companies be sort of thinking about positioning themselves for one of those two alternatives?
Yeah, I mean, I think, we normally exit 3 to 5 companies a year, and we did 2 this year, and everything's been pushed. Partly because the expected value of the company is not being met in the offers that we're seeing. The alternatives aren't always as great. The healthcare SPAC market has not performed to what one would have wanted, and so that maybe not always an option. The IPO market is can still be very valuable, delayed, but most companies within digital health actually exit privately. That's where your market is, and the question is, do you take the time to keep building the company by investing in it and just waiting it out until the market sort of rebounds a bit? And that's kind of the approach we're taking. Is we don't have to exit immediately on anything, and trying to invest in the company to help it grow and meet its numbers where it can maybe build back up to the type of valuation that they need is an okay move. But I can tell you, we have a couple in our portfolio that just for different reasons we'll sell them, but maybe not quite as what we wanted, but it's what the market's offering, and it's just time to get out. But we'd rather try to keep building the companies.
Again, I think totally agree. I think the goal is to build companies and get them through this current window. But I do think in some circumstances, having that dual track, being opportunistic and being open to a hungry buyer is a strong path. I still think we're seeing M&A, and we're still seeing hungry buyers, and they might be circling because of the threat on valuations. And so they see an opportunity, and you're starting to see that. But ultimately the goal is to build a transformative company. And I think, Bill, you mentioned it earlier, is that there is some increasing consolidation efforts in some of these spaces of, can we combine multiple assets to strengthen their financial profile and set them up for more significant growth and an easier raise in the future. So you are in certain markets. I think you mentioned one, data is a particular one where you're seeing a lot of consolidation. I think clinical trial space is another one, where in 2021 there may have been a large swath of companies that raised, and now they're all fighting for position, but maybe together they're stronger than apart.
So last question, and then we'll maybe open it up for 1 or 2 questions from the audience. What do you see your best CEOs, your best portfolio companies doing today, right? What 2 or 3 things do you think are really the hallmarks of navigating the choppy waters? What are the best companies doing right now?
I certainly think they manage cash very well. They prioritize really well. You can't do everything, but they understand what parts of the business that they have to invest in now and what can wait. So I think they intimately understand their business. They understand their customer and the customer needs still, better. The old funny thing is, just because you founded the company doesn't mean you know how to sell the product that but these companies that are doing really well kind of get all facets of managing the business, like a true, established P&L run business that, you would see on the NASDAQ or, the Fortune 500 kind of companies, even though they're much smaller, but they operate with that kind of mentality of how to survive and move forward.
And I think the one piece I might add is, I think the great CEOs in our portfolio are also thinking about the company and how do you create a really exciting environment for their employees to continue to thrive and be excited about what they're doing despite maybe difficult financing environment. Because I think the most important thing for any company is the people behind it, and CEOs that can manage that and still get people excited every day is a critical piece of it.
Fantastic. Jerry, Stan, do we have time for 1 or 2 questions? No, I'm getting the nod. No, we don't. But so, thanks, Bill. Thanks,
Thank you.
Paxton. Appreciate it.
Thank you.
So again, the lessons learned that we're picking up here are incredible, and having three experts who are at the core of this digital health reset and are looking at how to build new companies, architect new models, business models, and patient outcomes models. We're seeing now more than ever that this is happening at a faster rate than ever. Not as fast as it was 2 years ago, but again, what is the reset? It's about this new prevalence of seeing new models being built slowly but gradually and effectively, scaling carefully so that we do have sustainability in our healthcare system.